Okay, here we are again with practicing using our DEAD curls to do journal entries. This is part 2. We left off with transaction 9. So let's go ahead and complete transaction 9 through to the end. So here we have a payment of cash dividend. So on November 25th, a payment of $5,000 was paid for dividends. So we already have our cash account and we know cash is going down, and this cheat here tells us what happened when the account's going up, when it's increasing, so it'll be opposite side. So in our case, cash is an asset, it increases with a debit, so it will decrease with a credit. So we'll have 5,000 on the right side for credit. So let me just write those reminders for us. This is right side, that's what credit means, and then debit means left side. Okay. So let's continue on. We're going to make another T account for dividends. And dividends we can see there on our sheet. For our mnemonic DEAD curls, it increases on the left side, on the debit side. So we had nothing there before for dividends, and now we need to keep track of $5,000. So we can see our journal entry is going to have a debit to dividends and a credit to cash. So let's go ahead and do that. Make a little indent for space for cash. And I think I started getting sloppy near the end, the last of part 1, but since we're starting a new part video, we'll be correct for all the fill-ins, at least in the beginning. And so in the last line, you would write in a description. So this would be just paid dividends. Okay, and usually you get a drop down to choose, but you want to write some description of what's happening. And in the real world, when you do your journal entries, you don't get a drop down like you do in the publisher's homework problems. Instead, you'll write it in. So write in according to company policy of what they want for description. So pretty good description. Okay, so next we have is on December 1st, they prepaid 3 months of office rent. So they paid it in advance. So this rent was paid in advance. It's not expense yet. It hasn't been used. So it didn't say used rent or paid rent at the end of the month. Instead, they're paying it early. And so they have this future economic benefit of using time for rent. And so they paid in advance. So that was a prepaid, and it would be called prepaid rent, and that's an asset. So let's go ahead and bring up our sheet again that we had brought over. Let's see if we can drag it up. There we go. And we'll make another T account, and we have our prepaid rent. All right, and that was $3,000. So that asset of prepaid rent increasing on the left side. So we have 3,000 for a debit. All right, and we paid it, so that was cash. Let's just get rid of that circle so we don't get lost there in the, and so there we have, oops, almost made a cash increase, but we paid out cash, cash decrease, so opposite side, so it decreases with a credit. So we have a debit to prepaid rent, and we write debits first, and then we have a credit to cash. All right, so let's go ahead and do that. And you would write in the date and the description, but we're just going to do that. I think you got a hang of it from part 1. And then now I went over a little bit briefly in this part 2 video. There's cash. All right, easy enough. Transaction 11, payment of expense with cash. So they paid employee salaries for $1,200. So if you were to do your T account, you would say, okay, my expense account, salaries expense is increasing, and so that would increase with a debit according to DEAD curls. So we have salaries expense for $1,200, and they paid with cash. So cash decreases. Cash is an asset. When it increases, it's debit. When it decreases, it's a credit. Easy enough. Cool. Next one we have is they purchase a building with notes payable. They purchase a $60,000 building in exchange for a note. So we're just going to record that initial part of that note. And so we'll have a new liability account called notes payable. So I just told you it was a liability. So if we brought back our sheet over here for that, so we would have a T account for notes payable. And I had told you that that's a liability. So we looked over there. It's going to increase with a credit. And so we'll have 60,000 credit for notes payable. We didn't pay cash. Instead, we owe it. And then we got a building. And so a building is an asset. And so that's increasing on the debit side. Oh, very sloppy there. But we can see there, let's erase those circles because now we're looking at this one. We have a debit for building and a credit for notes payable. All right, I think you got the hang of the T accounts, at least from the beginning of the last video on this one, so we'll talk through them. So this is not as long of a video as part one was. That was extremely long. All right, and then spaces. Perfect. Almost done. They received a contribution in furniture with a fair market value of $18,000 in exchange for stock. So instead of Archer giving cash, like in the beginning in transaction one, let's just really quickly scroll back up to question one. We can see they gave cash of $30,000. Instead, they're giving an asset. So that's not bad. They're just giving something of value, which is furniture, and in exchange for stock. So it'd be very similar to this, except it's going to be furniture instead for a debit and then credit for stock. All right, not too bad, not too bad. So let's record furniture. And it's 18,000. And then common stock for 18,000. Not too bad. All right, now they had services received, Archer Spy Services received a telephone bill for $100 and will pay this expense next month. So they're going to pay this bill next month. They haven't paid it yet. They received the bill because they used their telephone, and so now they have to pay that amount, and so it's a liability. So they will have, it could be accounts payable, but in this case, in the books case, it's going to be utilities payable. So it's a payable account. So we know we're going to have an increase of $100 to a payable account for credit. And in our particular book that we're using, they do the account name as utilities payable. And we used the telephone already, so we have an expense to record for that usage, and expenses increase with a debit according to our DEAD CRLS. So we have utilities expense for 100, and then we have indent out a little bit, and then we have utilities payable. Okay, and that description probably be something like, just to tell you, because it's new, thought process, it'd be something like accrued liability, and in this case, it's accrued utility liability. All right, so you might see that as an option. What is that? I might as well finish it off December 15th. Okay, let's keep going. Let's see, they paid employees salaries of $1,200. So we'll talk later on about in chapter 3 about salaries, but we're just going to go with this example of how it is written this way. So we have an expense account for $1,200, and then they paid it with cash, so we'll decrease cash. Not too bad. All right, almost done. We just have 2 more. So this is transaction 16, so it's a little different. So we'll talk about this one a little bit. They engage, an agency engages Archer Spy Services to provide spy services, and they agreed to pay $600 in advance. So the customer, the agency, they paid in advance, but they didn't receive the services yet. So uh, Archer Spy Services owes these spy services to this customer. All right. The customer paid $600 in advance. And so Archer Spy Services did get cash. Yep. So we do have cash, our cash account increasing by $600. So we can do that one. We know that it's a debit, so we can record that first. So we'll just put that in since we know it. All right. And then now we know Archer Spy Services didn't provide the services yet. They owe the services to this agency. And so we have a liability that Archer Spy Services needs to record. And this is one of those liability accounts that don't have the word payable at the end. And it's just telling us that they didn't earn, so they owe these services. And so that account's called unearned revenue. So they didn't earn their revenue yet because they did not provide the services yet. So right now it's sitting there as a liability account. So unearned revenue, I'm just going to put a little note here in case you're writing notes. This is an liability account. All right, just to remind you if you're writing notes. So that's that. So it's something like the description to be collected cash for future services. Right? They collected cash in advance, and so they owe these services. And so until they actually provide the services, then they can record a revenue. So right now they can't record the revenue, they're recording the liability. All right, let's keep going. Last one. So our last one is transaction 17, and they collected cash of $8,000 for service revenue that the business earned. Oh, okay. So I was just talking to you about they didn't earn it in this one, and now in this case they did earn it, so they get to record revenue. So they got cash, so very similar to the other one for $8,000, and they actually did provide the services. So yes, now they get to record revenue. That looks good and increases their income statement, their net income by having an additional amount for revenue. So there's our journal entry. So that is it. That's all 17 journal entries. Just didn't want a long video. So this was 12 minutes to just finish up transactions 9 through 17. And then in the other part, you had transactions 1 through 8, going at a slower pace, practicing with dead curls. All right. We'll see you in chapter 3.